Let's stay on the markets here and bring in James Grant from Grant's Interest Rate Observer. James, good to speak with you here. Really enjoyed your latest edition, and I think in the latest edition, you highlight a very interesting point here, which I think the long-term cost of all this government intervention. We're seeing the debt continue to pile up. We're seeing the debt continue to pile up in corporate America. What is that? What do you think that means to the average investor?
For one thing, I think the numbers deserve to be just stared at, perhaps open-mouthed. It took 192 years for this country to amass its first $1 trillion in public debt. 192 years. That's 1789 to like 1981. And the latest trillion, we did that in 27 days. So that's, in a way, that's kind of progress, right? Well, it certainly is faster. And much the same kind of thing is on display in the corporate sector, perhaps not so very dramatic, but, well, for example, the Fed now has given its permission for companies to enter its mainstream lending program with ratios of debt to EBITDA of 6 times, which is very high. But because the Fed has fallen in with the present day way of doing business and accounting, it is now allowing, as of April 30th, it's now allowing adjusted EBITDA, which allows for the pixie dust of add backs and the like. So whether you're talking about the size of debts or of the way we account for debts, we have entered the age, what you might call it, of disinhibition. The idea of sound finance is kind of out the window, and in its place is the modern monetary theory of functional finance, which is that it's okay as long as it works.
Good point there, James. You know, the market seems to like all this ballooning debt and all this wizardry from the Federal Reserve. But as you zoom out, do you think we're looking at a decade of suboptimal returns?
I think we're looking at the near-term prospect of stagflation. Now, by way of preface, let me say that you see this phrase, foreseeable future. The Wall Street Journal used it on page 1 this morning. I can't look at that without wondering what in the world people think they can foresee. As of February, things seem kind of ducky in this country and the world, and they are sub-ducky at the moment. The future is, to my mind, at least a closed book. So we proceed on these questions of the future with the greatest humility, and you have to have some view, of course, but you can't be certain. So dogmatism is out. But having said all that, Brian, I would suspect that we are looking at a world of a very slow recovery. I wish it were otherwise, and it may well be, but it seems to me that we're looking at a fairly slow recovery and a gruesome profit picture and a lot of money and a lot of debt. And with macroeconomic figures we have not only not seen, but heretofore have not imagined. So, for example, new car registrations in the UK will be returning as of the latest rate of change to 1946 levels. And that is the kind of statistic we see almost every day. It's just astonishing.
Hey, James, Alexis here. What else can the Fed do, or would you like to see the Federal Reserve do to help ease this economic hardship right now?
Alexis, I'm not sure what the Fed can do to ease it. It is doing what it thinks is a helpful thing by opening the spigots, but in so doing, it is increasing debt. It is increasing the idea that the Fed is there to help us become more indebted. It is revving up the rate at which it emits what we call in the business liquidity, which is, a great gushing gobs of money. It is raising the stock market perhaps to levels it would not otherwise come close to trading at in the absence of these things. So I think the Fed is changing how things look, but it is not changing how things are. And I think that the danger with this well-intended, massive, unprecedented intervention is the widening gulf between appearance and reality. And so I'm at a loss to know what I would do if I were in Chairman Powell's shoes. I expect I might ask for a long vacation or perhaps a different career. It's a brutal question, but I'm quite confident, Alexis, that the long-term unintended consequences of these interventions are going to be substantial and not helpful.
James, real quickly before we let you go, what one action would you take if you were in Jerome Powell's seat right now?
I would say, ladies and gentlemen, we are introducing a massive financial stimulus, but please know it is ultimately artificial, and that the way wealth is created is not through our printing press, but from the workaday labors of talented, dedicated people who get up in the morning and do their best. And perhaps the thing to do, world, now I'm Jay Powell, is let us get back to work. Let us get back to work. So you may count me in the anti-lockdown camp, and I think that no matter what the Fed does, it is not going to substitute for commerce. Commerce is a fairly fragile thing, especially, Alexis and Brian, when there's no revenue.
Yep. All right, let's leave it there. James Grant of Grant's Interest Rate Observer. Good to speak with you, and stay safe.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.